Good day, fellow investors. A comment here requesting QSR, Restaurant International Brands, and I know a lot of you will love it, so let's do the standard analysis. If we look at the stock, it didn't do much the last 6-7 years. My son will love the 6-7, but the P ratio is 25, the dividend yield is 3.5, and we have to see now whether we can expect a boom in the next few years like the 2016-2018, as there are some developments. For those who don't know, Tim Hortons, Burger King, Popeyes, Firehouse, and some other iconic brands, franchisees, growing, expanding all over the globe per franchisor, some owned, some less owned, but profitability is there, so perhaps there's something for you if you want to open, but you need to work hard. Comparable sales, okay, growing, net restaurant growth, operating income, they are improving there, very good numbers there. Still, they are looking for more global expansion, more US expansion. They still see growth there, and their target is to grow 5% or more over the years and then reinvest double-digit total shareholder returns. If they hit that, the stock might get repriced. They are growing, increasing the number of stores, increasing the free cash flow, and as they are increasing the free cash flow, they will start doing buybacks. That might be a catalyst. So 2026, 500 million buybacks. They want to lower the leverage, which was pretty high over time as they did the acquisitions. 60% dividend payout, relatively good dividend. They will reduce capex as the growth changes the focus. And then we have the debt. So Tim Hortons, Firehouse subs, huge acquisitions, huge bets, and now we are, let's say, going for lower, which will perhaps be a good situation for the company. 1.6 billion total shareholder returns, that's good. Buybacks expected to grow, which will also grow the dividend per share. So it's all about the dividend and how fast it will grow. If buybacks add 2%, there is inflation 2 to 3%, organic 3% growth as they are expanding. Sum it up, that's a 10% return. That's their target double-digit return for shareholders. Of course, there are also risks. And let's put that into our intrinsic value table calculation. QSR, you can download this in the link in the description below. Check also the other links and you have the premium version on my research platform. Anyway, I've put in the dividend. If they grow at a conservative 6% per year, then the intrinsic value is around 63 for a 10% expected return, not far from the current stock price. 10% growth rate, terminal multiple at 30, which would imply a dividend of 3.3%. The present value is lower, and this is where, on top of the dividend, you could see some good returns. If things don't grow as planned, 2% dividend rate, terminal multiple, dividend going to 5%, then there is some kind of downside, but then you have to see whether it's just temporary or not, maybe to add up and reinvest the dividend. Now, if I compare that to others, it is a good return, 0.99% likely return. Accenture maybe a little bit more risky, Alibaba also. Who is there in line? Huge bet, growth story, AI disruption. Stable companies, Microsoft, Meta, but they hugely betting on AI. So perhaps among the stabler ones there. But there are also risks. A P ratio of 25 is not a P ratio of 12. Everything would be different with a P ratio of 12 and a dividend yield of 5-6%. Consumer pressure, GLP drugs, recession, competition. Every restaurant brand company that I look wants to grow. They will all grow. Of course, that is impossible. There is significant debt. If interest rates go higher, that is a risk. So always brand volatility, something is cooler, something is less cooler. Even if Burger King, McDonald's, whenever I pass in front, they're always packed. That works. So very interesting business, perhaps not to buy too much now, but certainly to follow. and I have put it here at a 9%, let's say, riskier situation to watch, and then we'll see over time where it goes. Thanks for watching. Check my research platform. I'll see you in the next video.